Hey everyone, and welcome. Today, we're going to pull back the curtain on the Straits Times Index, or as you'll often hear it called, the STI. It's really the heartbeat of Singapore's stock market. So if you've ever wondered what exactly it is and why it's such a big deal, you are in the right place. Let's dive right in. Our game plan is pretty simple. We're going to break this down into 5 parts. We'll start with the what. What is the STI? Then we'll peek inside to see what it's made of. After that, we'll get into the why it matters for investors. Then the practical stuff, how you can actually invest in it. And we'll wrap it all up with the key risks and takeaways you need to know.
All right, let's kick things off with Section 1, Singapore's Market Barometer. This is all about understanding why the STI is the headline number you always see for the whole Singaporean market.
So let's start with a really basic question. When you hear on the news that the market is up or the market is down in Singapore, what does that actually mean? How do you take all that crazy complex activity and boil it down to this one number that everyone can understand? Well, that's where the Straits Times Index comes in. The best way to think about it is like a market barometer. It gives you a quick reading of which way the wind is blowing. Now, it doesn't track every single company, just the top 30. We're talking the blue chip giants, the biggest and most actively traded companies on the Singapore Exchange. So its movement gives us a really clear signal on how Singapore's biggest players are doing. And you might be asking, who decides what's in and what's out? Well, the index's credibility really comes from who's running the show. It's a joint effort between FTSE Russell, a huge global index provider, and the Singapore Exchange itself. This partnership means everything is done by the book, with clear rules, which is why investors all over the world trust it. Okay, so let's move on to the next section. We know it tracks 30 companies, but which ones? What are we actually looking at here? It's time to pop the hood and see what kind of engine is driving this thing. So the magic number to remember here is 30. That's it. It's a pretty exclusive club. The whole point of the index is to focus only on the heavy hitters. We're talking companies with massive valuations and tons of trading activity. They're basically the corporate elite of Singapore. And this chart, wow, it really tells the story, doesn't it? Just look at that huge slice for banks, over half the entire index. This tells you everything you need to know about the STI's character. The financial sector, and especially Singapore's big banks, have a massive influence on how this index performs. The whole thing is deeply tied to the health of the banking industry. And to put an even finer point on it, look at this. Just 3 companies, DBS, OCB, and UOB, make up more than half of the entire index. It's pretty simple. When these 3 banking giants have a good day, the STI has a good day. That level of concentration is absolutely critical for any investor to understand before jumping in. But hey, this index isn't some ancient relic set in stone. It's a living, breathing benchmark. Twice a year, in March and September, it gets a checkup. They review it to make sure it's still accurately reflecting the top 30 companies. So companies that have grown can get added, and others that have shrunk might get the boot. This is what keeps the STI relevant. Okay, so we know what the STI is and what's inside it, but the real question is, why should you as an investor actually care? In this next part, we're going to dig into the unique features of the STI and what they could mean for your portfolio. First things first, we need to talk about a super important concept. When you look at an index, you often see its price return. That's just the ups and downs of the stock prices. But for an index like the STI, what you really need to focus on is the total return. This is huge because it includes the powerful effect of reinvesting all the dividends. And as you're about to see, dividends are a massive part of the STI story. And here is exactly why that matters so much. A dividend yield of over 4%, that's pretty significant. The kinds of companies in the STI are mature, stable businesses known for paying out consistent dividends. This makes the index a real favorite for investors who are looking for a steady stream of income, not just hoping for the stock price to go up. So who's this really for? Well, if you're an investor and your main goal is generating income, especially in Singapore dollars, the STI is basically built for you. It's also a perfect core holding for anyone who wants a solid foundation in their home market. And for global investors, it can be a great way to add a stable, defensive piece to balance out some of your riskier, high-growth bets. All right, enough of the what and the why. This brings us to the really practical part. Let's talk about the how. How can you actually get a piece of the action and track the performance of these 30 companies? Here's the thing. You can't just go out and buy a piece of the Straits Times Index. It's not a stock. It's just a list, a calculation. But what you can do is buy a fund that's designed to perfectly mirror its performance. These are called exchange-traded funds, or ETFs, and they're by far the simplest way to invest in the entire index with just one single purchase. On the Singapore Exchange, you've basically got three main choices. ES3 is the OG, the oldest and the biggest. G3B is pretty similar but has a slightly lower fee. But the real decision for most people comes down to this. Do you want the dividends paid out to you as cash? If so, you'd look at ES3 or G3B. Or would you rather have those dividends automatically reinvested to buy more of the fund for you? That's what GAB does, and it's a great way to let your investment compound over time without you lifting a finger. And the process itself, it's actually really straightforward. First, you just need a brokerage account that can trade on the Singapore Exchange. Then, you fund it. Search for one of those three tickers we just talked about, ES3, G3B, or GAB. You place your order, and you might want to consider a strategy like dollar cost averaging, which just means investing a fixed amount regularly. It's a great way to smooth out your purchase price over time. Okay, to wrap things up, let's talk about the other side of the coin. Because, let's be real, no investment is a sure thing, and it's so important to have a balanced view. So what are the key risks you need to keep in the back of your mind? Well, there are three main things to be aware of. First, that heavy concentration in banks we talked about, that's a risk. If the financial sector hits a rough patch, the STI is definitely going to feel it. Second, Singapore has a very open economy that depends on global trade, so a worldwide recession can hit it harder than more insulated economies. And finally, its stable, defensive nature is a double-edged sword. It might not fall as much in a downturn, but it might also lag behind more exciting, high-growth markets when things are booming. You know, a really popular strategy that a lot of savvy investors use is something called a core satellite approach. The idea is your core investment might be a big, diversified global fund for growth. Then you add the STI ETF as a satellite position, specifically for its income, its stability, and that home market exposure. It's a really smart way to try and get the best of both worlds. So, let's do a super quick recap. 1. The STI tracks Singapore's 30 biggest blue chip stocks. 2. It's dominated by banks and famous for its high dividend yield. 3. You can easily invest in it using one of three ETFs, ES3, G3B, or GAB. And 4. Investors often use it as a source of stable income to complement their other global growth stocks. And that brings us to our final thought. The STI is a snapshot of Singapore's economy today. But just like the economy itself, the index is always evolving. As new industries rise and old ones adapt, the face of the STI is going to change. And the big question for all of us as investors is, how do we position ourselves for whatever that future looks like? Thanks so much for watching.